Now we go to the section 7 or the agenda title 7, the equity, capital, and stock exchange. Okay, we will talk about different types of various kind of equity, and also we will share with you some characteristics of stock exchange. For equity finance, okay, we have two types of equity capital in the balance sheet. First of all is the ordinary share. Okay, the second one is preference shares. So what are their difference? Okay, they have differences in terms of voting rights. Okay, for example, you are the ordinary shares holders. You have the voting rights. For example, to make the decisions in the company's general meeting, no matter it's the annual general meeting or extraordinary general meeting, the AGM or EGM. It is the voting rights for ordinary shares. But for preference shares, okay, the preference shares holders, sometimes they don't have the voting right in the company decisions because they are not the ordinary shareholders. Okay, for example, they don't have the claims or they don't have the right to vote in what I call the AGM or EGM. So in general, the preference shareholders, they can only claim for dividends, but not the voting in the general meetings. And next is about the dividend. I just mentioned preference shareholders can have the right to claim dividends before or prior ordinary shareholders. Okay, because it is that advantage to claim the cash first, and the dividend is, but the dividend is not a compulsory. Okay, if the company can make money, the preference shareholders has the right to claim the dividends before the ordinary shareholders. And sometimes, okay, for example, if the company is not making money, then the preference shareholders cannot have any dividends. Also, the preference shareholders does not have any liquidation rights enjoyed by payables. But say if, for example, if the company is liquidated, the right to claim back their money is senior to the ordinary shareholders. So how about the unquoted or unlisted companies? Okay, in the world, a lot of companies are not listed in any exchange, in any stock exchange. And how those unlisted companies finance their capital? Okay, a lot of those unlisted companies, their funds are financed by their owner or the proprietorship, okay, or a partnership, for example. So because the financing is the source of financing is very limited, okay, only limited to the shareholders or their own proprietors. And why? The next question is, if the financing is so difficult, okay, how about, for example, it's only the shareholders? And next question is, why unquoted company shares are difficult to sell? Okay. First, if the company shares are divided into 2 or 3 parties, okay, maybe the company owned by 3 or 3 parties. When one of the shareholders would like to sell the company, they have he or she needs to notify the company on an intention to sell, and also notify the other shareholders on his or her willingness to sell the company's shares. And also, it is most important. It is very frequent that the existing shareholders, okay, has the right to buy back the shares in which the other shareholders would like to sell. Okay, so with limited buyer, and also you have to disclose your intention before, and also the shares, how to value. Okay, in general, it's valued by accountant. So in general, the shares is valued by what? By the net book value. Yes, the net asset value, in which is book value. Okay, the asset value in which is the book value. because the company shares are limited or restricted to any external buyers. In general, the shares are only sold to those related party, okay, maybe the existing shareholders. So it is very because the company shares are very difficult to sell. Then it implies that it is very difficult to raise new capital from the, for example, from other investors. Okay. So how about a quoted or a listed company? Okay, here is wrong. Listed. Quoted or listed companies. A quoted company is one where shares can be bought and sold on a stock exchange. Okay, in the world, the biggest stock exchange market is in US. Okay, in US, both New York Stock Exchange and Nasdaq. Maybe you know the names. New York Stock Exchange and Nasdaq. In US, yes, and in London, the London Stock Exchange, LSE, the London Stock Exchange. They are the biggest or the very big stock exchange in the world. And if a company, for example, can be listed in those exchange, they enjoy some privilege to others. For example, they have maybe a better or good reputation. So what's the advantages to be listed in the stock exchange? For example, you can attract more minority shareholder investors, or it is important to attractive to some minority investors. For example, if your company is to be listed in London Stock Exchange, then you have a lot of people looking at the London Stock Exchange. Your reputation, your company's reputation will be increased. Okay, and more people know your company, and they would like, for example, to investigate what your company is and what the business of your company is doing now, and also a lot of fund managers and a lot of institutional investors. Okay, they would like to check those companies in the stock exchange because they would like to use their funds to invest in your companies, and then it will push up the valuation of your company. Okay, the valuation will be higher, and it is easier to raise new capital. Okay, because more people know your company, and to the company point of view, it is more investors are reachable, so it is much more easy to raise new capital because you have a broadened investor base. Okay, because you have a wider investor base. Okay, and also the publicity, as I mentioned, the reputation issue. Okay, you have more exposure to the public. For example, in some financial news, maybe they would like to report which new company will be listed in which exchange. Then your name will be appear in those news or the financial news or the press, and it will help to improve or increase your publicity. And also the fourth one is about the borrowing. A lot of banks or debt investors, they would like to have more information before they are investing or they are lending you money. For example, if a bank, if you are unlisted, then the information of your company is very limited. It's only, for example, the financial statements will be only released once a year. But if you are a listed company, then you have to follow the rules set by the stock exchange. And for example, you have to disclose your financial statements twice per year, maybe, or even some countries, they have a more strict disclosure requirements. For example, maybe in each quarter, you have disclosed your financial information to the investors or to the public. So for for the bank's point of view, okay, it is more transparent, more information available in the market. They are confident to lend you money, so it is advantage to be listed because of borrowing is easier because as we mentioned before, for the cost of capital, there's two components in general. Okay, one is the equity, from the equity, the other financing is from the debt. So the cost of debt on average is lower than the cost of equity. So if you would like, for example, to lower your cost of capital, you would like to increase your company valuation, and then you would like to borrow some money from the bank or from the external market, it is a good signal for them if you are listed in the stock exchange and disclose your financial information on a regular basis. So they are happy to lend you money. Then your borrowing is easy. But the disadvantage, okay, is about the cost. It's about the cost. It's about the administrative cost. Okay, for example, audit fee. Okay, if an unlisted and listed company, if you ask me what's the differences between the audit fee, the audit fee differences maybe I can say is about several times difference. For example, if for an unlisted company, if just you would like to have an auditor to check to perform your annual audit of the company, the audit fee, for example, maybe $100,000. But if you are a listed company, then maybe more than $500,000. It's about not only double, maybe not only triple. It's different multi times of your audit of the fee as compared to what if you are not listed, because a lot of listing rules have to be followed. A lot of listing rules have to be followed, and your investor base are much wider. Okay, if you are a listed company, I just mentioned the major shareholders is, for example, is only one man, maybe holding the shares more than 80% or 90%. So the reporting is maybe only to a small group of people. But if you are listed in the stock exchange, it means your investor base is widened. Okay, more people can invest in your company, and the auditor is not only responsible for a small group of people or a small group of investors. He or she, the auditor, has to deal with a lot of investors. Okay, the recent case, for example, in India, one of the big four company, the PricewaterhouseCoopers, in the news saying that it was banned by the India to perform the audit work for listed company because in 2009, okay, it cannot meet some requirements because one of the company did audit telling lies to the public, and so the government would like to have some restrictions on PwC. And it is a case that the auditor to perform audit in the listed company has to be very cautious, and they need to do a lot of work to cover a lot of things, because if any mistake it made, okay, it will, for example, lead to any financial loss in not only just one or two persons. So there's just a group of people, the number may be huge. Okay, so you should be very cautious, and a lot of legal cases, okay, showing that all the firm would like to charge a bit higher price to those listed company because of they need to do much more work than those unlisted company. So admin costs will be high. Second, it's about the disclosure. As I mentioned, if the unlisted company, maybe the audited financial statement is required to share to the shareholders, maybe only 2 or 3 shareholders, and also for other regulatory requirements. For example, local company secretarial filing, or to the tax department filing, or some local regulation or rules required. So this disclosure for unlisted company is very limited, but for a listed company, the disclosure is huge. Okay, the amount of work in disclosure is huge because it has a lot of investor. The investor base is not only 1 or 2 people. Third is about a dividend policy. Okay, for a quoted companies or listed companies, it has to announce its dividend policy to the shareholders, to the investors, because a lot of people, they are looking for dividends. Okay, so if you have a transparent dividend policy, then the people are happy to invest in your company. Then the share price can be going up. Last but not the least is about the control power and pressure to achieve short-term results. If you are listed, okay, because of shareholders would like to look, a lot of investors are looking for a short-term gain. Honestly, they would like, for example, to buy the shares now, and maybe, for example, they would like to sell it, maybe 2 weeks or 3 weeks, if the capital gain, they are satisfied, so they would like to sell the shares. They are looking for short-term gain. Okay. Or within 1 or 2 years, they would like to look for example, 1 or 2 years, they would like to sell the shares. So those expectation is, those investor expectation is will cause the companies have some pressure to achieve short-term results. Okay. So move on. Next is about the stock exchange. We use the London Stock Exchange as an example. What's the objectives of the London Stock Exchange? First, all relevant information is made available to the public on a timely basis. It means any company listed in London Stock Exchange has to follow. Okay, every listed company in London Stock Exchange has to follow the disclosure requirements. All relevant information, once available, should be disclosed to the public. Okay. And next is all investors deal on the same terms and get the same price. Okay, what does it mean? It means the transactions in the stock exchange should be transparent. Okay, first of all. Second is they should have the same terms. All investors should in the same terms, no matter you only buy 10 shares or you would like to buy 10 million shares. Okay, they should face the same terms and the same price is possible. Okay, it depends whether the seller would like to what price that he or she would like to sell. Okay, but the information in the stock exchange should be fairly disclosed to different type of investors. Okay, so there's no discrimination of which kind of investors in the stock exchange. So they should deal with on the same terms and on the same price. And so for what kind of securities traded in the stock exchange? Okay, including shares, non-stock, convertible bonds, warrants. Okay, and for the government loan stock, okay, it is also they are also listed in the stock exchange for public to trade, and Eurobonds. Okay, Eurobonds. For Eurobonds, it means the bonds are denominated in the foreign currency. For example, the Eurobonds listed in London Stock Exchange are denominated in US dollars. Okay, it is one of the example. For the stock exchange, there are 2 tiers market. Okay, what we call is first is full listing, the other is AIM. So what is full listing? Okay, full listing means the company can meet all the requirements to have full list status in the stock exchange. For example, it has at least 3 years financial records. Okay, it is not a only new company formed maybe 6 months ago. It is a company which formed more than 3 years because it has 3 years, at least 3 years financial statements published. And also, if the financial statements are prepared in accordance to the UK standard, okay, to the IAS. And also, the company listed has to ensure the floating. Okay, what I call the floating means this percentage shares, the percentage of the total shares in the market circulated should be more than a certain percentage. For example, Some markets would like to ensure at least 25% of the shares are held in the public, not in any one individual or company. Okay, it has to ensure the company shares have some liquidity in the market because it can help the company shares to be evaluated at a fair price. If the shares in the public is only, for example, only 5%. Then it is very easy to manipulate the share prices because only 5% in the public. Okay. So some stock market, they would like to consider it is a critical part if the number of shares in the public cannot achieve 25%. Okay, for example, they may ask the company not to list it in their stock exchange. And the next one is AIM, Alternative Investment Market. For AIM, it is for small company. Okay, it is for small company. It is for small company. How small? Okay, very small. Maybe I can find some company listed in AIM. Their annual turnover is only about £100,000 in a year. It's very small. Okay, very small. But a lot of them are much bigger, and also for the AIM, the companies listed in the AIM market may not have any good track record of profits. For example, in the past 1 or 2 years, it cannot make any profits. Maybe it is only formed 2 years ago. So right now, the company would like to find a new source of finance by listing itself in the stock exchange. Then it cannot go into full listing, so it finally choose the AIM, Alternative Investment Market. And next one is would like to share with you is about the OTC market, over-the-counter market. Okay, for OTC market, it is a private market. Okay, it is a private market. Just the sales transactions between two parties. Okay, it can be go through without any exchange. Okay, just like in the market that I sell how many shares to you at what price. It's only two parties agreed without going through the stock exchange is fine. So it is called the OTC market or the over-the-counter market. Why is it called over-the-counter? Because in the past, when there's no no formulated stock exchange, if you would like to sell someone, you have to go to the counter and then you present it. You have an idea, and then the one in the counter will mark down what you would like to sell, and then he or she will wait for the buyers for your shares. Okay, it's the over-the-counter market. And for the procedures for becoming a quota company, okay. And here we have two types of procedures. Okay, first of all is the stock exchange introduction. For the introduction, there's no new shares issued. No new shares issued. Okay. What the example is, for example, if you a company, okay, maybe have 5 years history, and you don't have any finance, any needs to raise new funds. Okay, you don't have any needs to raise new funds, but you would like to be listed in the market. In case in future you would like to raise new capital, or right now you would like to have to improve or to increase your publicity in the market, then you would try to be listed in the stock exchange without issuing any new shares. Okay, it is possible. So it is what we call it is stock exchange introduction, but it has to follow all the full listing rules to ensure the company has the right or to be fair to all investors. The next is shares issued by quoted companies, include a lot of things. Okay, the shares issued, it means new shares or old shares are issued. It's mainly in new shares. Okay, new shares issued. We have rights issue, placing, offer for sale by tender, and also offer for sale by prospectus or public issue. Okay, we will share with you one by one. So next part is rights issues. So what is rights issues? It is an offer to existing shareholders to subscribe for more shares in proportion to the existing holding, usually at a relatively low price compared to the market price. So it means the company is already listed in the stock exchange. It would like to raise new capital, and it issued the rights to all shareholders, to all existing shareholders. So all existing shareholders have the same offer. Same offer include two parts: the price. Okay, they offer the same price, and also the number of shares. So it means for all existing shareholders, they have the same offer for price and how many shares that you can subscribe. Okay. So it says no discrimination. Any existing shareholders have the same rights on the company offer. So here is an example. Okay. CLK is a company currently has 2 million ordinary shares in issue and valued at $1 each. The company has annual earnings of $400,000. A 1-for-3 rights issue is proposed at an issue price of 80 cents. Find out the ex-rights price. Okay. Ignore any issue cost. Ex-rights price means we have the price now. Okay, we have the issue price. So what is the price after the right issue exercise? Okay. We have this information, 2 million shares now, $1 each, the valuation. Okay, and the earning is 400,000. And 1-for-3 rights issue is proposed. Okay, so let me share with you how to get numbers. We have 2 million shares. Okay, and the market price is $1 each, and we have the earnings. $400,000, and 1-for-3 rights issue, in which the issue price or the issue price is 80 cents. So what is the ex-rights price? Okay, so for 1-for-3 mean for any 3 shares you hold or you held, for 3 shares held, you have the right of subscribing one new shares. So you held or you hold 3 shares now, and then you have the right to subscribe 1 new share at this price. okay, at 80 cents. Okay, I just mentioned for rights issue, all existing shareholders have the same right or same offer in terms of pricing, in terms of number of shares that you can subscribe. Okay, so how to get it? Okay, you have the 3 shares now. So 3 shares times $1. So your market value is $3, right? And you have 1 right, and each right you can use 80 cents to buy new shares. So you have 4 shares, total investment how much? $3.80. So the theoretical price ex-right price is 3 times $1 plus 1 share times 80 cents divided by 4. Okay, 4 is how come to 4? 3 plus 1. So the theoretical price is 95 cents. Okay, 95 cents. So is it clear for rights issue? Okay, we just mentioned about what the definition of rights issue. And also we share with you an illustration. Okay. So next question is for rights issue. Should it be underwritten or not underwritten? Okay, so what is the meaning of underwritten? It means the shares issue okay can be purchased or finally purchased by one person or by one individual. Okay, because I just mentioned all existing shareholders are offered the rights to buy and how much, but some investors may give up the right to buy the new shares. Okay, so if the people they give up the right to buy the shares, it means the right issue, some of the right issue cannot be satisfied. Okay, cannot be satisfied. And in a lot of cases, in theory or in general, in principle, there's no need to have the underwrite process or under the any condition for underwrite to do the right issue. But in practice or in reality, underwritten is happened or quite frequent to be happened because a lot of companies they don't have shareholders enough or enough they don't have enough shareholders to accept the rights issue. Okay, there is a problem for them to raise new capital through the rights issue. So in general, it requires underwritten. Some shareholders would like to buy more, more in the market. But for example, some people would like to give up their rights, and some people would like to buy their rights in the market. Okay, so what's the advantages of right issue? Right issues, it automatically lowers the company gearing. Okay, because it is equity. Okay, if you can raise the new capital, new equity capital in the market, then it can help you to lower your gearing ratio. And the next one is normally fully subscribed. Okay, if it is not fully subscribed, then the right issue is failed. And also it has a neutral impact on voting rights because everyone are offered at the same price and same number of shares to be subscribed. Okay, so the impact on voting rights is neutral. Honestly, some people would like say, I don't want to subscribe. I don't want to subscribe. Okay, my shareholding is diluted. I'm fine. Then it's okay. But you have the right to do it, or to buy the shares, or not to buy it. Okay, so what's the disadvantages of right issue? EPS, the earning per share, is diluted. Okay, and the underwriter's fee is quite high, or other issue cost is high. Okay, for example, some rights issue, the cost may be more than 2%, 2 to 4% of the proceeds. Okay, for example, you raise $1 billion capital by rights issue. 1 billion. Okay, $20 million to $40 million are going into the middleman or those transaction costs. So it's not cheap. It's not cheap. 4% is quite high, honestly. Sometimes it's about 2% to 4%. And also the right issue usually forces shareholders to not, okay, so you cannot, for example, you cannot sit here and do nothing. Okay, you have to think about whether you would like to buy to buy the new shares by turning your right to be valid, or you consider by selling your rights and I don't buy it. And four, the market often skeptical about the right issue, tending to assume that the company is desperate for cash. Okay, it is contradictory with disadvantage, right? But in the market, for a company would like to have the right issue, in general, it is this one. Here's some problem. Okay, here's some problem. Okay, move on. It's placing. Placing. What is placing? A placing is a sponsoring merchant bank or investment bank or broker arranges for a few selected institutions to purchase all the new shares issued by the company. So it's different from the right issue. Right issue is all the shareholders have the same rights or same offer to buy the fixed or the limited number of shares. But for placing, only few selected institutions or investors, okay, by the broker or merchant bank can buy all the new shares issued by the company. Okay, so someone say placing is discriminating. Okay, it's not fair. It's not fair, or I say it's not fair. Not fair to all investors. Okay, but even it's not fair, but some advantages. Okay, in the placing, because the issue cost is the cheapest issue cost. Okay, because you have only selected investors with the price agreed maybe between the broker or merchant bank and those selected institutions. And those, but the disadvantage is, I just mentioned, is the pioneer shareholders are likely to lose control power over the company. It means some of the control are shifted to those selected institutions or buyers. Okay. So move on. Next, offer for sales. In an offer for sale, the company sells new shares to a merchant bank, like issuing house, which then offers them for sale to the public. Okay, it means a lot of new shares. For example, here maybe a company would like to be called or to be quoted in stock exchange. They would like to do it. I appoint a merchant bank to arrange the sale of my new shares issued to the public, and the merchant bank would like to follow some steps. For example, the merchant bank would like to recommend the price or the timing of the new shares issued, and the merchant bank has to do all compliance work with the stock exchange and the regulations department. Also, the merchant bank has to pay all professional fee like the accountant's fee or lawyer's fee. It arranged the offers to the public, offering the shares to the public, and how to allotment the shares and also underwrite the shares. So it is done by the merchant bank. Because a lot of work done by the merchant bank, so it charge you a lot of money. So it's the most expensive way to raise capital, but the advantage is the sum rate should be much higher for right issue or placing. For placing, only few selected institutions, so the amount of money raised is very small. For rights issue, quite a lot of money raised. It's not small. And for offer for sales, it should be a lot of money. Sometimes right issue can raise a lot of money. Not only offer for sales, but right issue sometimes. Depends on what's the company size. But for offer for sale, it generates a lot of money, much more than other rights. For example, rights issue and placing is correct. Next is about offer for sale by tender. It is useful when there is significant difficulty in determining an appropriate price. One example I would like to say, I think you all know this company, right? It's listed in the US some years ago, maybe 2004. It is an offer for sales by tender. But I'm not sure whether you know it. There's two types of tender. One is Dutch auction. The other is the English auction. So for English auction here, what we call is open outcry method or open outcry methodology. For the tender. Its style is anybody would like or they are interested to buy, for example, to buy a table. For example, a table, they just raise their hands and speak out what price he or she would like to offer. Then the highest price in the market or in the room will be offered for the table, or given it is much higher than what the seller wants to be. It's the English auction. But for Google, the listed of Google is through the Dutch auction. It's a Dutch auction. It's a set. It is like a descending price. A very high price spit out. Okay, if anybody accept this price, okay, it is done. But if the price is too high, then no one would like to raise the hand to accept this price. Then the price will be lower until one person raise their hand, and he can get the product. So it's a general Dutch auction. But the Google, okay, I would like to use one example is Google. How it raised new shares or how it raised new funds through the issuing the new shares. Okay, just one example. The number of shares issued is 1,000. Okay, so just ask the people how much that you would like to pay per share and how many shares you would like to subscribe. Then it lists out, for example, the price and number of shares. Okay, for example, the highest price would like to offer is 120, and number of shares subscribe here would like to subscribe here is only 200. The next mark is 115, and 300 shares will are interested at this price, and then it's 110, 400, 105, 500, and $100, 600. Okay. So total altogether is 2,000 shares, and if I would like to say for these 1,000 shares, would like to clear all these 1,000 shares. So what price should be offered? Okay, let's see. If 1,000 shares, okay, here's 200 minus, so 800 remaining minus 300, still 500. Okay, minus 400, 100. Okay, so for this, it will be cleared when the price is 105. Okay, so the issue price is 105 because all the shares can be cleaned at this price level. All people they offer 120, 115, and 110. They are happy to know that the price finally is 105. Okay, so it's a Dutch auction, so that's the price is determined by the market, and it's the best price to clear all 1,000 shares that the seller want to sell. Okay. Next one is the prospectus issue or public issue by the company. It's a bonus issue or reward existing shareholders. For example, it means there's maybe no new funds to be raised, only the new shares issued to those existing shareholders as a reward, or a scrip issue, or we say that. Okay, it's like a dividend, but it's not a cash dividend. It's the shares as a dividend to the shareholders by rewarding them. And stock split. Okay, stock split is different between bonus issue because some shares are selling at very expensive. For example, when Google initially listed, okay, it's less than $100 US. Okay, initially, okay, about $100. So after a long time, okay, maybe right now, I forget, but maybe more than 1,000 or even higher. So some management would like to say, okay, the share price is going up, I'm happy, but it also means I need to kick out some of the shareholders who like to buy our shares because it's too high, the price is too high for them. So I would like to have a wider base of the investors. Then I would say, okay, the stock split, okay, one for example, one share split into two, maybe for example, or for three. If one for two, then $1,000 maybe becomes 500 per share. Okay, it helps to improve the shares in the market in terms of liquidity. Okay, the liquidity of the shares in the market can be improved by this way. Okay, scrip dividend, avoid cash dividend avoid cash payment of dividends. So they would like to pay in scrip dividend. So it means issuing the shares as a dividend to the people, to the investors. Okay, so we finished this class, the third class, and here is a summary of our class. Today we talk about capital structure. We talk about WACC. For the capital structure and WACC, it means the traditional view versus M&M view. Okay, remember sometimes the examination question asking you about whether dividend is relevant. Okay, whether dividend policy is relevant in which view. Okay, so I hope you can answer it. Next, we go through about the capital asset pricing model. For capital asset pricing model, we explain in details and how to get the numbers. And most important part is about the asset beta and project discount rate or project specific discount rate. Right? It is very important to know the asset beta concept, because when a company would like to invest a project, an investment project, the risk is different from what it is existing doing. Okay, it is currently doing, then it needs to calculate the project specific discount rate to adopt this discount rate to discount the cash flow and see whether the net present value is positive or negative. Also, we went through capital asset pricing model and DBM. Okay, we share with you the disadvantages of capital asset pricing model and dividend valuation model. And remember, the most important word here is about risk. Okay, capital asset pricing model concerned about the risk. Okay, and then we go into we went to the source of finance topics. We introduced source of finance, whether it's internal sourcing or go to the external market to raise new capital. Then we describe about debt versus equity, and then we just went through the equity financing. Okay, we have shared with you, for example, some the stock introduction. Okay, there's no new shares to be issued, but it can be listed in the stock exchange. And the other is the company would like to raise new capital through the different type of activities, like for example, right issue, placing, offer for sale, offer for tender, or even for bonus issue. Okay, so we finish here for the class 3. Thank you.